Hi, welcome back to Wild Wealth Optimization Workshops. Back here, Scott Collier, the Call Dog. Excited to talk to you about this concept today. We're talking about mutual funds, segregated funds, different types of investments to help you to build wealth, to get professional money management, to diversify your portfolios. One of the key, something I'm a big believer in, is managed accounts, or what we call asset allocation portfolios. The importance of diversification in your portfolio, extremely important. So, what do I want to talk to you about here? These are essentially a fund of funds. So while it may have one fund name, such as Balanced Growth Portfolio or whatever that fund company calls it, practically every major investment company has managed funds where they have professionally picked a variety of different funds to suit their mandate around the relationship between return. The higher the rate of return you expect to get, the more risk and volatility you should be able to stomach, but to diversify, to spread out those risks on something that, watch for this one, when you're meeting with your buddies and you're at trivia night, this is it, the efficient frontier. You're going to be the only person that knows about the Nobel Prize winning concept. The efficient frontier, learned it from the Call Dog. So, what is that? That there should be a direct relationship between the return you get and the volatility that you can handle in your portfolio. But if the investment is properly diversified, using proper asset allocation principles, it should fit along the efficient frontier. So different companies may have different titles or different numbers of funds, but they all essentially follow this fundamental philosophy. Some of them now are using strategic investment strategies over and above just picking the investment funds inside the portfolio, and they're tending to pick funds where the fund that's their preferred bond fund, the preferred Canadian equity fund, the preferred US value fund, whatever the case might be, and they're building them all into these portfolios for this purpose. So the most conservative tend to be called income funds, then conservative funds. These will be primarily fixed income. Here maybe 80% fixed income, 20% equity, maybe 60 or 70% fixed income compared to 30-40% equity, and it just moves along this efficient frontier. Moderate portfolios, balanced growth, growth-focused portfolio may have now 80% equity, only 20% fixed income. An aggressive growth type portfolio could be 100% equity, but it will still be a diversified portfolio of equity funds inside that portfolio. Now, what do we know? When people are choosing only one or two specific funds, they tend to not fall along this efficient frontier. So for example, when we do computer analysis, that's a little higher tech than my little pictures here, maybe the investment falls here. What does that tell us? That if you can actually handle this lower rate of return, that you should be back here with less risk and volatility to get similar returns. However, if you can handle this much risk and volatility, you should be up here getting superior returns for that level of risk. Does that make sense? So that's ultimately what these managed accounts are trying to achieve. So I'm going to talk to you here about a little concept. Right, we know the markets tend to go up and down like a yo-yo. I want you to understand that from a financial perspective, if we invest your money this way, here you love us, then you hate us, then you love us, then you fire us, go get a new advisor. So one of the things that I believe in when it comes to this principle is you need to create offsetting checks and balances in your portfolio. And it helps to smooth the performance out. It'll never be perfectly smooth, but it'll take a lot of that roller coaster out of your investment account, your retirement portfolio, whatever it might be. So how do we create some of these offsetting balances? Asset class diversification. So what percentage should be equity, what percent should be fixed income? That helps generally when equity markets are dropping, fixed income markets are going up. What else could we do? Diversify globally. Do not put all your eggs in one basket. Canadian equities can be a good mutual fund, but it is not well enough diversified. Canada is primarily energy, natural resources, and financials. occasionally a big tech company that does real well until it eventually falls, i.e. RIM, Nortel, etc. So you have to have global diversification where different parts of the world hit different economic cycles, different market cycles on their investments. Diversification by management style. Some funds are primarily value focused, where they're looking for securities on a discounted basis. Others are very growth focused, where they may be willing to pay a higher price because they see the growth potential on an investment based on their fundamental analysis. Some might be somewhere in between there, or even a momentum manager, which is like a growth manager on speed. But you should have different investment philosophies within the portfolio. Generally speaking, when the markets are booming, the growth managers tend to do better. However, when markets plunge, the value managers don't tend to lose money the same way that growth managers do. So having a diversification of management style is very important. So the key is diversify. Don't put all your eggs in one basket. Have a properly managed portfolio. You can pick these pre-built management portfolios where investment experts have pre-designed the portfolios to suit your risk tolerance, investment objective, and time horizon. However, if you are going to choose to pick your own specific funds based on yours or your advisor's personal bias and expertise, then please make sure that you are still following the principles of diversification and asset allocation, because those will help to get you better returns while minimizing some of the downside risks in the market. Hope that makes sense and that you take that to heart. Look forward to talking.